Morning, everyone. Thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm the senior market specialist at FXCM, and my email address is r@fxcm.com. Just want to make sure, can you guys see the right screen? You guys see the slide, the FXCM slide? Just let me know. Today is Thursday, the 30th of June, 2022. Just going to bring up our Iris customer warning. Just want to make sure you guys can see. Okay, cool. Thanks, Lisa. All right, let's just keep this on screen for a few moments. And here's our market commentaries disclaimer. I'm going to keep this up for a few moments. Hey, Shadrach. Morning to you. Thanks very much. Nice to have you on the webinar. And here's our references. I want to thank all of you for joining this morning. It's highly appreciated. We'll start off with the Cnbc.com note. We'll just also reference the real rate. I think this is in print at the moment, but let's just go through the CNBC article for Europe. And it reads as follows: headline: European markets set to continue declines as recession concerns persist. European stocks are expected to open lower on Thursday as investor concerns with the health of the global economy persist. The lower open anticipated for Europe comes as market sentiment remains gloomy. There is no prospect of the war in Ukraine ending anytime soon, and inflationary pressures are likely to continue to build. With central banks looking to aggressively fight rising prices with interest rate hikes, there are growing fears of a global slowdown. On Wednesday, European stocks closed lower as sentiment remained bearish, with investors nervous about a possible recession. Overnight in Asia-Pacific markets, Chinese markets rose on Thursday as government data showed factory activity grew in June, but most other indexes fell. Meanwhile, US stock index futures were flat during overnight trading on Wednesday as the S&P 500 prepares to wrap its worst first half in decades. In terms of the last quarter, the Dow and the S&P 500 are on track for their worst three-month period since the first quarter of 2020, when COVID lockdowns sent stocks tumbling. The tech-heavy Nasdaq composite is down more than 20% over the last 3 months, its worst stretch since 2008. In other news, investors will be digesting the latest developments from the NATO summit in Madrid. NATO leaders have invited Sweden and Finland to join the alliance after Turkey withdrew its objections to the new members, and the organization reiterated its support for Ukraine, as well as outlined its plans to revamp its deterrence and defense strategy. Data releases in Europe on Thursday include French preliminary inflation data for June and Germany's retail sales for May and unemployment rate for June. There are no major earnings releases. Hey Zanetta, good morning to you. All right, so I think we want to just keep an eye on this chart here. We did this, I think, fairly well yesterday. It's the real interest rates have settled above zero, so they are positive. And the US dollar has locked in a very close correlation, sitting at 0.95. So as long as the real rates are moving upwards, and assuming that the correlation holds, we're likely to see a higher US dollar. Now, in that regard, I did tell you I was short Euro US dollar. Actually closed that just before I came on. Just closed it, but I'll probably get back into it if we start getting some bearish pressure. But this I showed you was open. I've now closed this. Okay, so and that's very much, you know, although clearly the technical signals are there, it's largely driven by the fact that I think the correlations here are important to watch. What I also want to keep an eye on what I also want to keep an eye on is the hey Anna, morning to you. Nice to have you on the webinar as always. What I also want to keep an eye on is the initial jobless claims. We are going to get those out today. Let me see if I can initial jobless. So it's this USIJC. I just want to bring that up. So this is coming out today. We're already starting to see layoffs. Okay, so one of the ones that made the headlines clearly was Tesla, but it's not the only company that's laying off staff. And it's no use waiting for the unemployment numbers to reflect. The unemployment numbers are lagging. I think the initial jobless claims is probably where we need to concentrate the analysis here. And what we can do is, I've shown you the 3-month moving average. I think we should put it back on. So let's just bring it in. I'm using a simple moving average here. And because I don't want any sort of mathematical speeding up of it. I actually want to see how the numbers relate to the actual 3-month average. And clearly, if we are starting to move above that, it's not a good sign, right? So we want to just keep an eye on this. Last time we did this, I wasn't sure if the stochastic was appropriate. I did some thinking there, and I think we can use the stochastic. It's just using one price for open, high, low, close over the period. But I decided it's probably good enough. So we just want to keep an eye on the. We probably want to just keep an eye on the momentum here. So the momentum has kicked up in terms of these initial claims. Now, I think where it will get very interesting is not so much on the initial jobless claims numbers, which I think in of themselves are a good series to watch in terms of economic analysis. But I think the continuing, see, these are initial, so these are first-time claimants, okay, that have just now started filing for unemployment insurance. But there is another series for the people that remain on the unemployment insurance, and that's called continuing jobless claims. Slightly different series, but let's just take a look at it. Just got to get my spelling right. Continue. There we go. All right. So this is the continuing USCJC. So it's not quite as dire. You can see it's not quite as dire as the initial claim. So if we do get a movement of the just want to see. Okay, it doesn't make a difference. It's weekly data regardless. So what happens here is we want to just see if this moves above its 3-month moving average. That I think is a really bad sign in terms of hard landings. So the initial filings typically have to come first, right? That makes sense. But if those initial filings remain on unemployment insurance, they move from the initial claims onto the continuing claim series. Well, that means there is a problem, because the commitment, not commitment, it's not the right word. I guess the necessity to remain on the unemployment insurance is stark. And so I think that we haven't quite seen this, but take a look at how it's converging towards. In fact, I never use a MACD, but let's just put on a MACD here. I'll tell you why in a moment. Let's take the stochastic off. Let's just throw in a MACD. All right, so can I make any sense of this? All right, so I was looking at the MACD. I really don't use the MACD because I can't. It doesn't make much sense to me. But the fact that the series, the economic series, is starting to converge on the 3-month average. I was thinking perhaps we'd see that on the MACD, and perhaps we can see it. What I'll do is I'll try and adjust the settings here. Let's change the inputs. So instead of 1226, I'm going to change this to, I think the lowest I could get just 2, and then we'll change this to 12. I don't think I can use a 1 here. A 1 would effectively be the price series. Let's see if I can. That's interesting. Right. So what I'm looking at here is I'm looking at the actual convergence, divergence of the 12-month moving average and the series. And according to MACD, you know, it started. You can see it started converging already as far back as really December. That's interesting. The point being, okay, that I think that we are going to get a crossover on the continuing jobless claims, and I think that's a bad development. I think that's the worry now. So this afternoon we're going to get PCE. We're going to get PCE data, but I think that there is a shift in emphasis moving away from inflation, which we know is a problem, but we also know that the central banks are now focusing completely on that to the point that they're neglecting employment. It's not a big deal, I think, for the banks that only have price stability as their mandate, but it's a big deal for the Fed, who has full employment as their mandate. So the idea here is, so we started converting here, and it looks like we'll get the movement up pretty soon. That's bad news. Chris just saying, can I maybe reconcile job openings with jobless claims? Possibly. So the data that you want to look for there, I think, is the JOLTS data. I'm not sure if it's here. Let's see if we've got JOLTS. Yeah, okay, so JOLTS. So here's job openings. Let's just take a look at total non-farm. Let's see what's happening here. Okay, and okay, it's also with weekly data. It's weekly data. So what we can do here, Chris, is we can just keep a look at the JOLTS data with the 3-month moving average as well, right? So we've got the 3-month simple moving average, and you can see that it's starting to dip. So those job openings are starting to decline. Let's take a look at this in terms of the stochastic and the RSI. Possibly we'll throw in a MACD as well. It's not really my favorite indicator, but we'll see what we can see. All right, let's put in the stochastic. All right, so the stochastic still hasn't really dipped out of that 80 area yet. So it's still very strong in terms of the momentum. This is a lag. There is a slight lag attached to this slow stochastic. That may be what's happening here, which is exactly what I think might be happening on the continuing claims. Let's see RSI. All right, so the RSI is now started to pull back. It was clearly overbought, showing that there was way too many job openings in terms of the indicator. Job openings versus number of potential applicants was skewed. But I think that is in effect a sign of possibly maybe last gasp. I'm not sure. It's starting to moderate on the RSI. What we can do here, let me think about this very carefully. I think that keeping the overbought, oversold levels here are not quite as useful as taking a look at it in terms of the 50, Chris. So perhaps if it drops below this 50 level, I think that would be the bearish movement on the indicator. It would probably be that we're now below the 3-month average as well. So you can see the job openings are starting to come down as well. Now, job openings starting to come down. There is the just thinking, what other way can we take a look at this? Let's take a look at it in terms of a fast stochastic. Try to get rid of the slowing factor. Okay, so the fast stochastic is starting to roll over as well. Let's just add in a MACD just to make the analysis sort of uniform as well. So let's take this out. Okay, let's just put this back or slow it down. So what I'm just trying to take a look at is the convergence towards the 3-month moving average. Let's just put that in. And what we'll do is we'll just drop this from 1 to 12 and see what we get here. All right, so the kind of crossover is taking place over there. In terms of the signal line, the true convergence started taking place from about there, Chris. So that's where the divergence maxed out, and now it's starting to converge in. Does that answer your question, Chris? It was a really good question, by the way, looking at openings versus the. So I think that this in of itself is not looking particularly good. Another way to take a look at this, of course, which we have looked at previously, but not lately, and Rob brought this up previously, is in terms of hours. I'm not sure if we'll have this. Yeah, this is it. So this is a monthly. You can see this is a monthly series. So monthly series. So the monthly series, we'll just drop this to 3-month, right? So we'll take a look at it in terms of the 3-month average. So hourly hours worked are now below the 3-month average because it's monthly data. So we've just switched this down. So this again is another it's a bad sign. I mean, here is this one's not the complete series. All right, it's not the complete series. All right, we're only going. This is lockdown over here. That's odd. All right, we've got to find one that's got the complete data on it. Sorry about this. This is not going to help us. It's not showing us the correct data until now. So I can find that on the Fred website and download it. We won't do it. We won't look on here. There's something weird going on here. This comes from Fred actually. All right, that's all right. All right. Okay, Zanetta, thanks for letting me know that. Oh, that would be terrific. Anytime you get a moment, you're certainly most welcome. Can we also look at the Great Recession? I don't think the data will go back as far as the Great Recession, unless you're talking about the global financial crisis. Rob's here, USAWH. Let's try that. Thanks, Rob. Okay, cool. Yeah, thank you, Rob. All right, this is weekly, and let's just amend this to a weekly average. So we'll have to change this to 12 weeks to make 3 months, right? So let's get a 3-month reading here. So you can see this is the right data. So thank you very much, Rob. We are clearly below our 3-month moving average, a simple moving average. And the MACD here shows the, I guess the max divergence between the series was in May, and then it started increasing, but increasing at a decreasing rate. That's the way to see it, until eventually it's rolled over. So what we have here is a picture that has job openings which are starting to they're starting to decline, okay? Or if they're increasing, they're increasing at a decreasing rate. I think that we can say they're declining. They haven't crossed over that 12-month moving average yet. We can see that hours worked has come down. We can see that the initial jobless claims is going up. And we can also see that the continuing jobless claims, whilst below their 3-month moving average, we converging and are dangerously close to a crossover. And what is this all telling us is that workers, employees, seem to be in a very precarious position as the Fed tries to, and not just the Fed, central banks, but when I refer to the Fed, you know, they the central bank of central banks, I guess. They're trying to manufacture the soft landing whilst they're fighting inflation. And I think that the point is the soft landing is probably unachievable. Probably, perhaps they put a rabbit out of the hat, but I think that we can see that we are starting to we're teetering, aren't we? We're on a knife edge here. Let's just see how much data we've got here. Chris saying let's just compare it to the previous recessions. I'm just going to press all here. So we don't have the dot-com bubble here with this data, but you can see how hours work, average weekly hours comes down during the global financial crisis. And let's just take a look at it at the other series. Let's take a look at the job openings. Let's just press all here. All right, so you can see this is the aftermath of the tech wreck here, Chris, how it comes down, Here it comes down during sort of lockdown period, and now we're starting to converge again, aren't we? Let's take a look at initial and continuing claims as well. So this is difficult to read. It's difficult to read because of the spike. This is obviously a sort of a real shock to the system, very much a black swan. If we change it to logarithmic, it will help. Okay, so we get we can kind of get a better read here. So you can see that we go up to 2001 and then we come down. Go up to December 2008, come down. All right, so let's just see if we can put this into perspective. Here is the tech wreck. Here is the initial claims rising. Here is the global financial crisis. Here is the initial claims rising. See that, Chris? I don't think we sort of need to take this into account. This is this really is an anomaly, an outlier. Let's just go back to continuing claims here. Continuing. Okay, here we go. All right, so something I just want to show you here, something that's very interesting. Okay, so you can see here is the tech wreck. Okay, here's the .com bubble. Here's the global financial crisis. So these are continuing. Now, what we want to do is we want to take note of the lag between initial and continuing. Okay, so let's just go back to the initial. And let's just get rid of this at the bottom. And just to make it simple, we'll put the continuing underneath, right? So we can see it on the same chart. So let's put that in. All right, so let's make this logarithmic here as well. And let's take out all the drawings and start from the beginning. And let's add a 3-month moving average here as well. All right, so we look, I think we're comparing sort of apples with apples, so to speak. So let's just see, here is the crossover for initial, say the 1st of July, and here is the crossover for continuing, 1st of October, and here is the crossover. This is pretty close. I'm just trying to, this is pretty close with one another. Here's pretty close with one another. Around about 1st of May, they kind of pick up. Perhaps let's say this is coincident. Initial claims here. Wait a moment. Apologies. All right, I was looking at it on the monthly scale. Let's just do one by one. All right, so the initial over here, and jobless continuing, let's say, over there. So not that big a lag, say about a month in between May and June. Okay, cool. Sorry, I was looking at it on the wrong time scale here. I want to go back to weekly. And let's just go back here. So this is now the global financial crisis. So there's like some sort of dislocation over here, kind of corrects, and perhaps we can say it really sort of moves over there. So also pretty close to one another, And let's go back here. Let's change this to the weekly. And so here we can see there is a lag. Okay, so we just want to keep an eye on this. It's not lining up quite as neatly as the previous. Zanetta just writing, there's massive sales on everything, gold, silver products. Sellers trying to get rid of products, so there's no buyers. Yeah. So what's happening there is that I think where it's most stark, most interesting, Zanetta, is the inventory buildup for the large retailers, right? That made headlines. Let's just see if we can see that. Inventory. I'm not sure if I'm using TradingView with for a lot of the heavy lifting here. Let's see. I don't see the spec. I know that there is inventory picking up. So yeah. So what happens when you have a big build up in inventory? Well, you're going to have to sell those on sale. It also means that you're going to stop ordering new goods until you clear, right? So you're right there. You can see how the economics is going to work, and that's clearly recessionary when there's a large build up after a cycle, after an expansionary cycle. All right, we've done a lot of economics. I think just to close off, if there's any questions, go ahead and type those in. The picture is obviously not looking particularly encouraging. With that said, let's take a look at the DAX. Just showing you Euro starting to move again. That's interesting. All right, let's just go through to DAX here. All right, so we've now moved into the support area on the weekly, and we've got this movement in the stochastic, and we want to see if we hit that 20. If we hit that 20 and hold, that's going to be vicious. It's going to be vicious. If it holds at 20, that's momentum strength to the downside. 80 is momentum strength to the upside. 20 is momentum strength to the downside. That coupled with the lower peak, lower trough, very nasty. Take a look at our zones. Back into zone 3, strongly back into zone 3. 1, 2, 2, 3, 1, 2. There's that market pulse, right? There's that market pulse. And then take a look at the stochastic. Okay, can we get into this? It's going to be difficult because the signal was given yesterday. Signals given yesterday. It was actually given on the 28th. Okay. Possibly sort of slow down here, hit that central pivot, coming down. The short-term position is certainly oversold. So the risk reward here is starting to skew. In other words, there might be a floor underneath us right now. If there's a floor underneath us right now and we are shorting, we could land up on the wrong, even though we might be on the right side, assuming that this bear market continues. Everything moves in 1, 2, 2, 3, so zigzags, 1, 2, 2, 3 zigzags. So what I like to do, I think you guys understand the 1, 2, 2, 3. So yeah, just going back to euro, 1, 2, 2, 3, 1, 2, 2, 3. But the 1, 2 here, watch this very carefully. The 1, 2 here is not confirmed. Stochastic's lagging. Okay, stochastic's lagging. So 2 trigger system, and even if the trigger's pulled, nothing happens until the momentum kicks in. Okay? And the momentum's got to kick in. Okay, this was nice bearish momentum there. Okay. So this is kind of so let's just go back to the DAX and go back to the DAX, and the DAX 1, 2. Now I don't know where this 1, 2 is going to end. We may have it. We may have a really horrific day on the market. We could have. Imagine that this is an extended 1, 2. I don't know if that's going to happen, but at some stage there will be a 2, 3, and kind of. I think that would be a better risk-adjusted entry. So it depends on your conviction and your risk tolerance. We are in a very fragile market. The downside momentum is very strong, but I'm just worried about the oversold condition here. Just finally, just before we sign off, Chris just asking if we can take a look at the COPOC indicator. And actually, Chris, that's a very good suggestion because it's the 30th, right? So we're right near the end of the month, and you want to look at the COPOC indicator on the monthly scale. So the end or the beginning of the month is ideal. So certainly should look at that. So let's just take a look at the DAX here. So we'll bring up the FXCM DAX. And we'll throw in the COPOC here. I'm just going to adjust this, just make it darker. And then remember, we must look at it on the monthly scale. So just hit the monthly button here. Now we're very close to that 0. We're not quite there yet. We're not quite there, but we're getting pretty close. Okay, so again, the COPOC is prone to giving whipsaw signals, but when it gives a good signal, it's really a signal that's pretty close to the low, right? So we've got to get below 0 here for it to activate, so to speak. We're not there yet. Again, it doesn't mean that the market can't start moving up. It can. It's just that The COPOC really has a good track record in terms of cycle lows. What we can do is we can also take a look at the US 30. You can see we're at 11.59. Yeah, I'm not going to, here's the zero. I'm not going to put the zero in. We've got a little bit more to go here. Let's take a look at the S&P. All right, and then the Nasdaq is going to be exceptionally interesting because the one that's been hit the hardest. So let's see where the Nasdaq is at the moment. Amazingly, the Nasdaq, as hard as it's been hit, still hasn't registered below zero yet. So we get very close. I'm not sure if I showed you guys the PE ratio. Let me just see if I can find it on the S&P 500. I think it's here. Just see if it comes up. It's not so easy to find. I'll have to, it's in our Q3, which is going to be released hopefully today, tomorrow the latest. We're looking to host it today. Yeah, I have found it. It's obscure. It's not so easy to find. All right, we'll take a look at the P ratio. I'll just show it to you on the. I've got a copy of the. I've got a copy of it on the on my Word document that I did with the Q3. Let me just see if I can find it. So just give me one moment, I'm begging your pardon. All right, so this is Q3, but I just want to show you this. All right, so this is the S&P 500. This blue dashed line here is the mean, sort of the average over, and we're going back here to like 1870, so that's the mean. The green is the first standard deviation on either side of the mean. Orange the second standard deviation, and the red is the third standard deviation. So you can see tech wreck, global financial crisis all hit past the third standard deviation. And then we've last week, a big one, last year in June 2021, we hit the third standard deviation. And usually what happens after we hit the third standard deviation, there does seem to be some sort of pullback towards the mean. There seems to be some sort of pullback towards the mean. Now, I don't know if that's going to happen. Having only two previous samples, doesn't make a statistical population. To make any sort of statistical inferences from that is weak. But that's all we've got. And interestingly, we only went past the second standard deviation, from the late 90s. Crazy, isn't it? But the idea here is if we're going to pull back to the mean, then price has to come down. But remember now, this is a PE ratio. We're not only looking at price, we're looking at price over earnings. So the PE has to adjust on the price side and the earnings side. Okay, that's the complication of looking at the P. Where's the adjustment going to take place? Is it going to take place on the numerator, or is it going to take place on the denominator? Well, I think the denominator is coming down. Okay, Wall Street is most likely taking forward projections down. Now, if they're taking forward projections down, then it's the denominator that's dropping. Well, that would suggest a higher PE ratio, but that's not what we're saying here. We're saying that we've got to get down to blue. So if the denominator is already moving down, well, in order to reach blue, price has to correct down even faster, which would suggest that there is still possibly another leg down. I hope that kind of makes sense, all right? If it doesn't make sense, we're kind of out of time, and we can do it again tomorrow when I actually have the trading view. I'll get the trading view data in front of me, but the point is, every time we've gone past the third standard deviation, the corrections do come back to the mean. Now, there's a problem with this analysis, okay? It's not as neat. It's not as neat as what we're saying, okay? It's not as neat, and the reason it's not as neat is because this assumes a normal distribution of PE ratios, and it may have been a normal distribution up until the late 90s. It's certainly not a normal distribution now, because we've spiked above the third standard deviation 3 times, in such a short period compared to the history. So there's some sort of skew going on here. So there's a big question mark how relevant the assumption of moving back to blue actually is. And what kind of a skew is it is obviously a good answer. Well, because the mean, that's this blue line, is slightly higher than the median, okay, which is the number slap bang in the middle, it implies what we call a positive skew. Which is interesting, okay. But we won't delve into that much more than what we have. We can do it again tomorrow. We're going to email it out. We're going to email the links out, and so it's still the final. Everything's done. I just want to email this morning, just the final report. Just they've sent back to compliance. So we've already got compliance approval. I think they just want to, dot their I's, cross their T's. They want to make sure everything's 100% compliant, and then when they get that final sign-off, it's going to be hosted. So just keep an eye out in your inbox. All right, guys, I think we'll leave it there, and thank you very much. Yeah, okay. I think it's difficult. Yeah, we'll talk about it again tomorrow. All right, guys, let's wrap up here, and have a good day, good evening. We'll chat tomorrow. Cheers, guys.